So right out, I urge you all to watch this in 1.5x speed. So markets are in dire situation. Stocks have fallen 40% and still we were quoting earlier Warren Buffett quotes like be greedy when others are fearful. Still our feet are shaking to take the plunge. What if I buy today and the stock fell by 5% tomorrow? Won't I lose that 5% gain? So what strategy should we adopt in this environment? So we should be able to pick businesses with robust business model and bid aggressively in them if they are available at throwaway valuations. So how do we gonna do that? For that we have to get an understanding about the various businesses, and we have to be doubly sure that whatever we pick it won't go to zero. So we are gonna devise a method today which is though not foolproof, it will do broadly fine. So we are gonna pick secular growth sectors only. So financials, consumers and NBFCs, sorry, consumers and technology. So financial, there is balance sheet led businesses and businesses without balance sheet like AMCs, insurance, brokerage and depositories and uh, a few of them maybe I forgot. Then these balance sheet led businesses, lending businesses like banks and NBFCs. So NBFCs, they can be divided as deposit taking and non-deposit taking, and some of them are categorized as systemically important by RBI, and then also there are different categories like the loan book they have, like home finance companies, and there are a few NBFCs which are doing uh, all types of loans under its ambit. And then there is this microfinance companies lending to these self-help groups. So this microfinance business we are going to avoid whenever there it is cyclical. Whenever there is any natural calamity like flood or drought or COVID comes every 3-4 years, NPA, their NPA goes to stratospheric levels. So we are going to avoid this microfinance lending businesses, and focus on this HFCs and other NBFCs. But more on that later. Firstly, we will go with bank. So banks are these private banks and PSU banks. So we will talk about private banks only. So private banks, there can be large banks and then mid-sized banks, and then these regional banks. They dominate in their region or state, but the problem with regional banks is they are led by generally owner promoter, and then he is only managing the bank also. So this promoter management combo, it is a bit scary, because see, banking is a leverage business. The promoter can start a company and take loans from the bank and siphon off money there to his personal accounts and show losses on the loan book. He can easily do that. So even today there is one order where court has admonished CBI on some 2,500 crore loan of SBI gave to the CG Power, to his the CG Power's former promoter. He did some scam. It is beyond the scope of present discussion, so we will leave that. So market doesn't generally look favorably and won't give valuation to this promoter management combo led banks. This promoter management led banks the same valuation on par with this professionally run banks. So large banks like HDFC, ICICI, Kotak Bank, they are run by professional management, and then there are these mid-sized banks which are also professionally managed, and have this pan-India ambitions, they are also worth looking at. So in banking, there are a few parameters like ROE of 15%, ROA of 2%, net interest margin of 4%, cost to income ratio of 36-37%. These are considered gold standards. And they beyond doing ROE beyond 15% is anyway difficult for a bank because of various statutory limits by RBI, imposed on them by RBI. Like they have to maintain this SLR, CRR, capital adequacy ratio. So anyway, doing ROE beyond 15% is difficult. But few of these phenomenal banks like HDFC, ICICI, they are doing 17-18% ROE in recent times. See, whatever names of the companies I am taking, it is obviously not recommendations, just telling you for example. So in this mid-sized bank, they have ambition to reach these gold standards, these numbers. They aspire to reach there. And then see, growing a lending business and growing loan book is not very difficult. If you want to give loans to people, you will definitely find people who are in need. But then the thing is, how are you gonna recover the money back? Say, then balance sheet will deteriorate if you won't be able to do that, and NPA would increase. So you have to balance out the things, the growing loan book and also managing the NPA. So bank has this advantage over NBFCs that they have low cost of funds. They have the saving accounts, current accounts. There's some NBFCs which are deposit taking like Bajaj Finance, Shriram Finance. They also take deposit from customers, but they are time deposits, FDs and all. But banks have this saving account and current account, which on saving account they pay maybe 3.5%, and current account they take fee from the corporates who maintain current account with them. So bank have this added advantage. So their cost of fund is low, so they can lend at lower rates, and then the risk profile of the customer whom they lend, the banks, it will be stellar. And typically a customer, an NBFC charges higher than a bank, and customer goes to them if they are rejected by loan application is rejected by the banks. And also there is this nowadays this thing about turnaround time, technology's involvement. These NBFCs, they quickly process the loan and give money very quickly, but banks are adopting the same system and are getting on par with these NBFCs nowadays. So typically credit profile of a customer of NBFC is lower than that of a bank. So video has got a long. So if you have any question till now, you can ask in the comment box, and we will carry on this in the next video. Thank you.